Hello, everyone, and welcome to this lesson on venture planning. So we're going to kind of get right into it with this. So why is it important to allow for flexibility in your entrepreneurial or your venture planning process? Venture, in this case, is your entrepreneur, whatever your entrepreneurial venture. That makes sense that you're getting at. Well, the 18th century poet Robert Burns, he wrote, "The best laid plans of mice and men often go awry." And Mike Tyson, a former boxer, said, "Everyone has a plan until they get punched." Yikes. So it's important to understand that when you are creating something like a new business venture, what you are doing hasn't been done before, or at least hasn't been done in the same way that you're doing it. So you are doing it your own way. So while it's very important to plan for the short and the long term, it's also important to remain flexible and be able to adapt when needed. Because throughout history, whether in nature or in business, those who are disciplined to a strategy, but at the same time are most able to adapt to change are usually the most successful. So you've got to stick to your strategy, but you also have to be able to adapt to change. So there are essentially two types of entrepreneurial or venture planning. One is strategic planning. Now, strategic planning is inspired by your vision of the future, your mission, what you're planning to do. Um, the operational planning describes how you are going to get there. So strategic planning, what is it? Well, your strategic plan, it includes your big goals for the next 3 to 5 years. It also includes major initiatives and projects that will help you achieve those goals. And it includes your measuring stick. Now, notice the measuring stick is in quotation. So what is that? Well, measuring stick is your various targets, your milestones, your KPIs. KPIs, by the way, are key performance indicators. Okay, KPIs, key performance indicators that will be monitored and measured to ensure that you're on track and that you're hitting your goal. So strategic planning, it needs to include a good understanding of your market, okay? Your target market, intimate knowledge of your competitors, their products, their services, their business models, and their go-to market strategies. Now, on the other hand, operational planning. Your operational plan gives details department by department and by functional area of how you are going to achieve that strategic vision and what objectives to focus on in the near term. So operational planning, from that operational plan, you can create individual performance plans that are drafted for each employee to know how she or he can contribute on a daily basis. This is the important part, is contributing on a daily basis. This is what your employees are doing to help you reach your plan. Now, venture plan also includes some other things. It includes your product development strategy. For example, are you manufacturing something? Are you making something? If so, where are you going to source or where are you going to find your parts to make it? Are you going to manufacture domestically or offshore? Are you going to manufacture it, let's say, in the United States, or are you going to have it made in, let's say, China? If your product is a tech product, you need to include your software tools, the languages, the platforms that you are going to use to develop it. And also outline who is managing some of the key functions, like what will the CEO's major focus be? And who is your CFO? CEO and CFO, two important, remember, key important terms. Your chief executive officer and your chief financial officer. So some other things that venture plans include is how your company is going to be funded. Where are you going to get the money? Are you going to do it with investors? Are you going to do it with debt? Or are you going to do it as a combination maybe? You ought to include what's called a pro forma or a projection of your sales revenue, your expenses, your net income, your capital needed for your company's operations. So a pro forma is a projection of all of those different things. Who is going to manage the operations, the marketing, and the manufacturing? Who is responsible for ensuring all of the federal regulations or legal regulations are complied with? Whose job is that? These are all things that you want to think about as you're doing your planning. Now, Stephen Covey, he wrote a book called The 7 Habits of Highly Effective People. And one of the habits, habit 2, in fact, was called Begin with the End in Mind. So what does that mean? Well, it means that if you believe your company can really grow into a big enterprise one day, you might need to raise more investment capital. But if you end up not growing as fast or as big, then you might wish that you hadn't given up as much of your company to investors. When an investor puts money into your company, they typically own a part of your company. If it doesn't grow, then um, they're having ownership that maybe they shouldn't have because it didn't grow as big. So it's a very important balance to strike. But when you start with a fully developed plan and you be ready to adapt to changes and obstacles that come your way, because here's the thing that I've always talked about or always thought is the only constant is change. So some quick additional notes for you. So think about what a business plan is. Now, a business plan is your roadmap of your business's objectives and the strategy and the details of how those objectives are going to be achieved. And your mission statement. What is your company's purpose? Its reason for being, the problem that it's solving. So two key things: business plan, your mission statement. Financial forecasting and budgeting. Here's some additional notes. Okay. Remember, as I said, a pro forma is an estimate of the current and future years of revenues, expenses, net income, and the capital, the money needed to fund your company's operations. A sales forecast, this is different. It projects the sales anticipated to be achieved in the future. And an operating budget is a plan that estimates your revenues and expenses. Companies use that budget to monitor and to manage your revenue and your expenses and to compare the actual results versus to that operating budget. Some additional notes. Some internal and external analysis tools. SWOT analysis. SWOT, strengths, weaknesses, opportunities, threats. SWOT analysis is analysis of those things of a company. And also sometimes you might want to do a SWOT analysis on your competitors. Now, market analysis is an analysis of the total size of your market, your TAM, for potential sales, your target market, and your competition. Market analysis is very important to understand who your market and your target market is. And of course, then an environmental scan, which is carefully monitoring your surroundings in order to detect early signs of opportunities and threats that may influence your current and your future plans. So all of these things, these internal and external analysis tools, are very important when you're building and considering your business. More notes for you, more internal and external analysis tools. You want to think about a competitive analysis, and this is an analysis of your competitors' products, their pricing, their business models, their go-to market strategy. A sensitivity analysis is predicting the outcomes of decisions by creating and changing a certain range of variables. The analysis allows you to determine how changes in one variable affect the outcome of the whole. So one variable can change the outcome of the whole thing. Now, some strategic planning approaches. There is an opportunity management approach. This is where you identify, plan, analyze, manage, handle, and monitor initiatives and projects that yield potential cost reductions, schedule reductions, and/or performance improvements. There's also what's called a milestone planning approach. Now, these milestones measure your progress and show important achievements during a project's life cycle and represents a sequence of events that build until the project is complete. Milestone planning uses these milestones, these kind of stepping stones, as a way of measuring your and signaling your project's potential success. To seek internal revenue or input, to assess for needs for budget checks, and as a moment in time to decide if the project is still a go or if changes need to be made. So keep in mind these two different types of planning approaches. There's also entrepreneurial strategy matrix. Now, a matrix analysis. This is a matrix analysis of the level of innovation, the high or the low, and the level of risk, high or low, associated with a venture. Then there's also a multi-stage contingency approach. This approach reviews your venture, your business, at each critical phase of its development to ensure that the venture, the business, maintains its viability, is it any good, and its scalability, can it grow? Now, There's a lot of technology that can be used for venture planning. Now, for example, QuickBooks is a software program that's often used for bookkeeping, keeping track of your sales, and your budgeting. Microsoft Excel is also used to build pro formas for financial planning and analysis. So keep in mind all those strategies. Keep in mind your operational planning, your strategic planning, as you are working on your venture, your new business, your entrepreneurial endeavor. And that is our lesson on venture planning for today.